Okay. Moving into interest rates and where we are with interest rates. I mean, certainly there's been a lot of anticipation about will the Fed cut the Fed funds rate this year? We have yet to see that happen. That's a big question for people. When is that going to happen? And certainly we don't have a crystal ball. We don't know. But what are we seeing with interest rates? What do we think is potentially a likely course for 2024 with rates? And then also talking a bit about, and we can all chime in here, how that impacts the types of investments we're looking at.
Yeah, so I'll lead off. So on this call back in July, we said the Fed was done hiking. Be it either lucky or good, that view proved correct, at least so far anyway. Today, we continue to believe that the Fed has no reason to raise interest rates further. The Fed itself and financial markets have largely come around to the same view. As Liz mentioned, we've gone from 0% to almost 5.5%, which, by the way, is a ton of credit tightening over the past, almost 2 years without an increase in unemployment. So job well done so far. So it seems the more relevant question now is how long will the Fed stay up here before cutting rates? That's what everyone seems to be focused on. So far, it's been about 7 months from their final hike in July through today. The historical average of the plateau in interest rates is closer to 9 to 10 months. So maybe there's a little bit of time left. Obviously, that's just using history as a guide, not a prediction. But we think going forward, the answer to when the Fed pivots will largely depend on the path of the economy and the path of inflation. So there's three possible outcomes, and I'll hit on them real quick. If a recession soon hits, the Fed will have to ease policy, both because unemployment will surely rise and inflation will fall. And they may have to ease aggressively. And the good news is they have room to do so because they're up here at about 5.5%. So there's room to cut. The second possibility is the economy holds up, but inflation continues to drift lower towards the Fed's target. And under that scenario, the Fed could also cut, but just not as quickly and probably not as much, because if inflation's coming, the Fed cares about real interest rates. And if inflation's coming down and they keep their Fed funds rate at a nominal 5.5%, then all things equal, credit conditions get tighter on a real basis. So the Fed could track inflation lower to keep financial conditions consistent and steady. And then the third path is the economy holds up and inflation stalls out here in the 3% zone, or worse yet, things reheat, which might lead to no cuts for a while, or maybe even another hike or two. So as we think about those three different paths, those three different possibilities, we think that path one or path two is by far and away the most likely. Path three is highly unlikely, but time will tell. So the Fed's likely to cut here at some point, maybe mid-year, we'll see. And everyone's watching, of course.
Everyone is watching.
Yep. And as we look at the yield curve, where, as you highlighted in your opening remarks, Liz, longer term interest rates are lower than short term Fed funds rates, which suggests that the market does expect both inflation and rates to come down, partially due to what the Fed is doing to get inflation to come down. That is what a 10-year Treasury bond interest rate, for example, is an estimate by the market of all the players of what they think the rates will be over that time horizon. So there is still a sentiment that rates are moving in the right direction.